Okay, this is the second part of the video that I did. 30 minutes later, 45 minutes later, we're looking at the same chart, the Euro US dollar chart, and it's a 30-minute chart. And we're gonna take a look here, and you'll be able to see why these indicators are so important. I made the mistake of jumping in here on this candlestick here, this when I thought, again, emotions, that the MACD, the faster moving average, was going to cross over the slower moving average to the upside. And the MACD histogram was going pretty good, so I thought it was going to break above the zero line. And obviously the third indicator, which is the 13-day exponential moving average, was on its way to break the line, but it didn't, and I jumped in anyway. And again, got a little greedy, and I should have never jumped in, but I did, and it turned right back on me. It turned to the downside, and I took a loss of about 45 pips to the downside, because I didn't wait for all three indicators to be in sequence. And as you can see, it went parallel instead of breaking, and I thought it was going to break here. That's why I jumped in, and it pulled a fast one on me and turned the other way on me. I'll show you an example of where it would have been a good time to get in, and all three indicators were telling me so. Would be right here on this time frame here, where you have the price movement break below the 13-day exponential moving average, and at the same time, right here is where it would have been ideal to get in. As you can see, I'm gonna see if I can keep this steady here. Okay. Oops, right there. You can see the price movement broke below the 13-day moving average. You got the histogram, MACD histogram, right here, breaking below zero, going to the negative side. And if we go down a little further, you can see that the faster on the MACD, the faster moving average broke below the slower moving average, indicating that there's going to be some price movement to the negative side going down. This would have been ideal to get in right here, and as you can see on the chart, by doing that, you would have caught this price movement to the downside right here. So you would have made over 100 pips easy on that move alone. And then it starts to consolidate here. And again, I should have waited to get in, and I will continue to wait now because I got burned. So it's all about trying to keep emotion out of it. Sometimes it's kind of hard. I jumped in at the wrong time. All three indicators, obviously it didn't break the 13-day moving average, and it didn't go above the zero line on the MACD histogram. And as you can see down here, it's still parallel. It's still going parallel. So the faster moving average didn't break above the slower moving average on the MACD. So I should still be on the sidelines. I wasn't. I got stopped out and I lost 45 pips. But it's a perfect example that the three indicators here have to be in sequence, and you have to follow the rules in order for you to have a successful trade, whether it be to the upside or downside, doesn't matter. But the indicators have to tell you that, all three. That way you can limit your risk. It's all about trying to limit risk. And obviously I got burned on here because I got a little greedy here, and I got in and I lost 50 pips on it, and I got greedy. And as you can see, this is a live chart. It's still not breaking above the zero line on all three indicators. So I will be on the sidelines until all three indicators tell me that there's going to be some price movement to the upside. And I hope this video will help you with your trading, your Forex trading. Thank you.